What happens when a massive winter blizzard wipes out attendance at a major destination resort, but the company somehow, ends up making more money than if the storm had never happened?
I mean, it sounds like a riddle, right?
It really does. Welcome to today's deep dive. Today's Friday, May 1st, 2026, and our mission is to unpack a massive, freshly released 40-page financial document.
We are looking at the Q1 2026 earnings report for Ryman Hospitality Properties. You might know them by their ticker symbol, RHP.
And honestly, just getting our hands on this raw, unfiltered data felt a bit like a covert operation.
Oh, absolutely.
We literally had to prove we weren't malicious bots to the Cloudflare digital bouncers just to get you this alpha.
Yeah.
It was sitting behind a market-beat security verification wall.
It's always revealing to see what sits behind those enterprise security walls. And for you listening who might hear the name Ryman and immediately think of, like, the historic country music auditorium in Nashville, we should probably establish the scope of what we are actually looking at today.
Yeah, that's a great point. They're way more than just that.
Right. Ryman Hospitality Properties isn't just a hotel company. They are a real estate investment trust, or a REIT. But they occupy a very specific, incredibly lucrative niche.
The massive destination resorts.
Exactly. They specialize in massive, group-oriented destination resorts. So if you've ever walked into a sprawling Gaylord resort...
Oh, the ones with the massive glass atriums?
Yes.
Yeah.
Indoor rivers, acres of convention space, all under one roof. That is their core business. And they pair these gigantic real estate assets with a really robust entertainment portfolio.
And our goal today is to look past the dry accounting tables and the gap reconciliations. We want to discover how these massive, heavy footprint convention hubs are actually performing in early 2026.
Because they are operating in a highly dynamic economic environment right now.
Right. And as we were about to see, they're dealing with some major unexpected natural disruptions. So, okay, let's unpack this, because the top-line numbers in this first quarter report are frankly staggering, but they contain a glaring contradiction.
They really do. But let's start with the sheer volume of money moving through these properties. The top-line figures are just breaking records across the board.
Yeah, walk us through the numbers.
So Ryman reported a record first quarter consolidated revenue of $664.6 million.
Wow.
Right. To put that in perspective, that is an increase of 13.2% compared to the first quarter of last year. They also hit a record consolidated net income of $69.4 million.
That's huge.
It is. But the metric that real estate analysts really pay attention to is their adjusted EBITDA. That hit a record $219.3 million.
Wait, okay, before we throw too many acronyms at you, let's break down why adjusted EBITDA matters more than just standard net income for a company like this.
That is a crucial distinction. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization for real estate.
That is a mouthful.
It is, but it's a profitability metric specifically designed for real estate trusts. Because Ryman owns these massive physical buildings, standard accounting requires them to log huge depreciation expenses.
Right, the accountants assume the building is losing value over time.
Exactly. But in reality, prime commercial real estate often appreciates. So, adjusted EBITDA strips out that accounting fiction, along with interest and taxes, to show you the raw operational cash flow of the business.
And hitting $219.3 million in a single quarter shows their core operations are functioning like a highly tuned engine.
Precisely.
And it's not just about what they did in the past 3 months, right?
Yeah.
It is about what they are locking in for the future. I saw they reported over 460,000 same-store gross definite room nights booked for future periods.
Yeah, and the word definite is doing a lot of heavy lifting there.
It's the difference between a tentative hold and a signed contract, right?
Exactly. When an association planner commits to a definite room night, they are signing a legally binding agreement, often years in advance, with strict cancellation penalties.
So securing nearly 500,000 of those nights in a single quarter gives Ryman incredible visibility into their future cash flow.
It does.
And they are securing that future cash flow at a premium. The average daily rate, or ADR, for those future bookings is $303. That is a 6.7% jump compared to the prior year.
Right, and based on this outperformance, CEO Mark Fioravanti actually raised their full year 2026 outlook.
But here is the massive contradiction staring at us from the text.
Mm-hmm.
In the very same statement where the CEO celebrates these records, He explicitly points out that Winter Storm Fern severely impacted attendance at multiple properties at the end of January.
Right. He specifically names Gaylord National near Washington, D.C., and to a lesser extent, Gaylord Texan and Gaylord Opryland.
Right, so you have a major weather event actively suppressing physical attendance at your biggest properties, grounding flights, keeping people home, yet you somehow shatter revenue records for the quarter.
Yeah, it makes no logical sense on the surface.
It's like planning a massive, expensive outdoor wedding, getting hit by an absolute blizzard where half your guests can't even fly in, but somehow you end up making more money on the cash bar and catering than you projected for a full house. How does a real estate trust physically pull that off?
What's fascinating here is the underlying mechanics of how convention properties actually generate their revenue. It is fundamentally different from, say, standard Marriott or Hilton.
Okay, how so?
Well, a typical hotel relies on heads and beds. If the room is empty, revenue goes to zero. But massive destination resorts operate on a different model. The CEO noted that the financial losses from Winter Storm Fern were entirely offset by a highly favorable group mix.
Group mix. So we are talking about the specific types of corporate, medical, or association groups
Right.
that actually made it to the resorts.
Exactly.
So the groups that braved the storm happen to be the ones with the deepest pockets.
Essentially, yes. The groups that showed up were willing to pay a higher average daily rate for the rooms. But the real magic happened outside the guest room. They drove a massive surge in what Ryman calls outside the room spending.
Let's visualize what that actually means for a conventioneer. Outside the room spending isn't just like buying a souvenir t-shirt in the lobby.
Oh, definitely not.
We are talking about the massive gala banquets, the intricate audiovisual equipment rentals, and the mid-morning coffee breaks where a single pastry costs $20.
Right. And to put hard numbers to that visual, the report highlights that their same-store banquet and AV revenue contribution per group room night actually increased by 6.6% year over year.
Wow.
Yeah, Ryman uses that specific metric as a proxy for how much catering is spent per group guest. So imagine a pharmaceutical company hosting a major conference. 10% of their sales reps might get snowed in and cancel their flights.
But the company already signed the contract for the prime rib dinner for 1,000 people.
Exactly. And they are still renting high-lumen laser projectors for $5,000 a day for the keynote speech.
So the high margin revenue is locked in, regardless of the minor fluctuations in headcount.
The catering minimums and AV rentals create an incredible buffer. When you combine that highly lucrative locked-in group catering with an exceptionally strong spring break leisure travel season in March.
Oh, right. Families paying premium rates for the indoor water parks and resort amenities.
Exactly. You completely erase the financial damage of a January blizzard on the East Coast.
That is incredible. But all those high-margin catering dollars aren't distributed equally across the map. That brings us to the micro view of their properties. To understand who carried the weight this quarter, we need to quickly define two industry metrics that are plastered all over this report: RevPR and total RevPR.
Right.
For you listening, RevPR stands for revenue per available room. You just take the total room revenue and divide it by the total rooms available. It is a standard hotel metric that tells you how well you are filling your building and at what price.
And standard RevPAR is fine for a roadside motel, but for a massive ecosystem like a Gaylord resort, it only tells a fraction of the story.
Right.
That is why Ryman focuses obsessively on total RevPAR. Think of these resorts like cruise ships on land. Total RevPAR takes the room revenue and adds in the food, the beverage, the spa treatments, the entertainment tickets, the parking.
Basically, all of that ancillary spend.
Exactly, all of it, and then divides it by the available rooms. It measures the total economic extraction from the property.
And when you look at total RevPAR across their portfolio, you see a dramatic tale of two different realities in this first quarter. Let's look at the overperformers first. Gaylord Opryland in Nashville generated a total RevPAR of almost $494. That is a massive 16.5% increase year over year.
That's huge growth.
And Gaylord Palms in Florida hit a total RevPAR of over $631, up 10.5%. But then you have the shiny new heavyweight they acquired in June of last year, the JW Marriott Desert Ridge in Phoenix.
Oh, the operational numbers coming out of Desert Ridge are almost unbelievable. They ran an occupancy rate of 73%, with an average daily room rate of nearly $490.
Just for the room.
Just for the room. When you factor in the resort spend, their total RevPAR hit $863.95,
Wow.
generating over $860 per available room per day across an entire quarter is a staggering achievement.
It is an absolute cash machine. But then you look at the properties that took the brunt of the weather. Gaylord National, up in Maryland near D.C., saw its occupancy drop 9.4 points down to 63%, and its standard RevPAR fell 6.8%.
And Gaylord Texans saw its RevPAR drop 8.3%.
Right. So I have to push back a little on the CEO's narrative of absolute systemic dominance here. If you strip out Desert Ridge-like, the shiny new toy they just bought, their same-store RevPAR only increased 2.1%.
Yeah, that's true.
That barely keeps pace with baseline inflation. So are their legacy properties actually growing organically, or are they just using the massive margins from Phoenix to mask stagnation across the rest of the board?
Well, that 2.1% same-store growth metric is definitely the weakest link in the top-line narrative, and it is a fair critique. However, you have to view that 2.1% through the lens of structural risk mitigation.
Okay, what do you mean by that?
Well, Ryman owns 12,364 rooms spread across drastically different geographic climates. They are acutely aware that massive, heavy footprint properties are highly susceptible to regional weather anomalies.
But if inflation is running at 3 or 4%, and those same store properties are only growing at 2.1%, you are technically losing ground in real terms. Is holding on to a massive, aging asset in a volatile weather zone really a strategic hedge? Or is it just an anchor weighing down the explosive growth of their newer properties?
I'd argue it is absolutely a strategic necessity because of how the convention industry actually operates. Major corporate and association events do not stay in one city year after year, they rotate. A major medical association might do Orlando one year, Phoenix the next, and Washington, D.C. the year after that. To capture that recurring business, Ryman has to offer properties in the East, the Central U.S., and the West.
That makes sense.
A brutal winter storm in the Northeast that depresses occupancy at Gaylord National is a temporary hit. It is subsidized by spring breakers flocking to the desert warmth of Phoenix or Florida. They purposefully bought Desert Ridge to ensure that when one geographic region inevitably falters due to seasonality, another is peaking.
It smooths out the severe volatility that traditionally plagues the hospitality sector.
Exactly.
Here's where it gets really interesting, though. We've been talking entirely about hotel metrics, banquet halls, and geographic real estate. But Ryman has an entirely different wing of its business that seems completely out of place.
The entertainment side.
Right. They own an approximate 70% controlling interest in Opry Entertainment Group, or OEG. Why is a company that focuses on corporate convention real estate messing around in the music business?
On paper, it does seem like a bizarre tangent for a real estate trust. But OEG is a cultural powerhouse. They own the Grand Ole Opry, the historic Ryman Auditorium, WSM Radio, and the Ole Red brand of restaurant and live music venues.
However, to your point about the financials, the entertainment segment actually struggled a bit this quarter compared to the hospitality dominance we just discussed.
Yeah, looking at the data in the source, entertainment segment revenue was actually down 11.6% to $79.18 million, and operating income fell almost 59%.
The CEO attributed this drop to a really tough year-over-year comparison. Apparently, Q1 of 2025 was an absolute record high for them, plus the fact that Winter Storm Fern hit their Nashville venues hard, keeping tourists away from the live shows.
Right.
But despite a nearly 60% drop in operating income, they were throwing massive amounts of capital at expanding this segment.
They are expanding at a really aggressive pace. They just announced a 7th Ole Red location being developed in downtown Indianapolis. What is notable there is they are partnering with Pacer Sports and Entertainment, the organization behind the NBA's Pacers, with an expected opening in late 2027. They are also currently building massive Category 10 live music venues in Las Vegas, set to finish late this year, and they are breaking ground on another one in Orlando this summer.
Okay, I have a theory on this, and I want to see if the mechanics support it. Is Ryman essentially using these multi-million-dollar entertainment complexes as a massive, profitable, top-of-funnel marketing campaign for their convention centers?
It's an interesting thought.
Because spending millions to build a country music sports bar in Indiana seems completely random until you realize Indianapolis is one of the premier convention hubs in the Midwest.
If we connect this to the bigger picture, your theory aligns perfectly with their stated strategy. These aren't just random neighborhood bars. As Ryman outlines, these are iconic and emerging country music lifestyle brands.
Look at the specific markets they are targeting, Las Vegas and Orlando. Those are arguably the two most competitive, high-volume convention and group travel markets in the world.
And crucially, where are two of Ryman's biggest resorts? Gaylord Palms is right outside Orlando, and they are clearly targeting the millions of convention goers flowing through Vegas.
So they are fishing where the fish are.
Exactly. It is about capturing the customer journey far beyond the hotel lobby. There is a deliberate, calculated overlap between the demographics of the live country music consumer and the corporate convention goer.
Right.
Let's say a massive HVAC convention is taking place in Las Vegas. Maybe those attendees are staying at a competitor's hotel. But when the convention floor closes at 5 p.m., where do they go?
They take their corporate expense accounts to a place like Category 10.
Exactly. By planting flags in Tier 1 convention cities, Ryman captures the massive out-of-room entertainment spending of tourists and business travelers. It builds intense brand affinity that loops right back into their core hospitality business.
Wow, so if you have a great time at an Ole Red in Vegas, you might be more inclined to book your next corporate retreat at a Gaylord property.
It is a closed-loop, highly synergistic ecosystem.
That reframes the entire entertainment division for me. It's not a side hustle. It's a net to catch convention dollars anywhere in the country. Now, let's follow the money. Because building multi-story country music complexes in the most expensive entertainment districts in America, while simultaneously running massive resorts, requires an unbelievable amount of capital.
Oh, absolutely.
Let's look at their balance sheet, because the financial engineering happening behind the scenes reveals a lot about how they view the macroeconomic environment.
The balance sheet maneuvers in this quarter are a masterclass in defensive corporate finance. In March, Ryman completed a private placement of $700 million in senior unsecured notes due in 2034.
Okay.
They took the net proceeds from that massive debt issuance, paired it with some cash on hand, and used it to completely pay off $700 million in older notes that were due to mature in 2027.
Wait, so they essentially wiped out a massive debt payment due next year by taking on new debt that isn't due for another 8 years.
Yes.
On top of that, they reported sitting on $424 million in unrestricted cash, and they have $930 million in borrowing availability on their credit facilities. They also maintained their quarterly cash dividend of $1.20 per share, rewarding their investors.
Right. But here's the catch. They're burning through a staggering amount of cash on physical upgrades. They project spending between $350 and $450 million in capital expenditures, or CapEx, just in the year 2026.
That is wild.
And that capital expenditure is being deployed rapidly across their biggest assets. They are executing massive room renovations at Gaylord Texan and JW Marriott Hill Country. They are continuing a major meeting space expansion at Gaylord Opryland.
Right, and they just finished the Foundry Fieldhouse, which is a massive sports bar and pavilion at Opryland, and they completed a highly lucrative meeting space conversion at Desert Ridge. But wait, taking on $700 million in new debt while projecting nearly $500 million in property renovations feels incredibly aggressive. Is refinancing this debt just moving a massive financial time bomb from 2027 to 2034? Or is there a structural advantage to locking in this specific debt right now?
To understand why this is a brilliant move, you have to look at the concept of maturity walls in commercial real estate. If you have $700 million coming due in 2027, you are entirely at the mercy of whatever the interest rates and lending environment look like in 2026 when you go to refinance.
Oh, I see.
If the credit markets freeze or rates skyrocket, you could be forced into a distressed sale. By paying off that 2027 debt right now, they aren't just moving a time bomb, they are securing runway.
They bought themselves an 8-year, stress-free window where they do not have to worry about a massive maturity wall.
Exactly. They took the existential dread of a looming debt payment completely off the table. That is huge.
And because they secured that runway, and because they're holding hundreds of millions in cash reserves, they have the freedom to pour $500 million into property renovations today. Think about their competitors.
Right.
If a peer hotel chain is paralyzed by high-interest, near-term debt, they cannot afford to replace their carpets, upgrade their AV systems, or build new pavilions. Over the next 3 to 5 years, Ryman's properties are going to look dramatically fresher and more technologically advanced to event planners.
It shows immense confidence from their board that they can utilize this clean balance sheet to outspend the competition and capture market share while others are struggling just to service their loans.
It really does.
So what does this all mean? When we step back from the gap margins, the complex real estate metrics, and the corporate debt structures, the story of Ryman Hospitality Properties in early 2026 is one of relentless structural resilience.
Yeah. They are leveraging a massive resurgence in group travel, capturing high-end catering and AV spending to shatter revenue records even when weather decimates attendance. They're utilizing a smart, geographically diverse footprint and strategic entertainment investments to capture convention dollars across the country. And they are executing high-level financial engineering to upgrade their massive castles while their heavily indebted peers are forced to play defense.
It truly is a masterclass in specialized heavy footprint real estate management. But this raises an important question, one that goes far beyond just Ryman's quarterly earnings and touches on how we all work today.
Okay, where are you going with this?
We are living in an era of elevated macroeconomic uncertainty, and we are still locked in an endless cultural debate about remote work versus the traditional office.
Oh, yeah. The endless back and forth of whether the physical corporate headquarters is dead.
Precisely. Yet, here we have a company specializing strictly in massive in-person group meetings, and they are seeing their highest first-quarter same-store group room night booking production since 2018,
Yes.
locking in future dates at record-high prices.
Right.
It makes you wonder, what if the death of the traditional office hasn't destroyed corporate culture at all? What if it has simply relocated it? If a company's employees are distributed, working from home 50 weeks a year, that 2-week massive corporate offsite at a Gaylord resort isn't just a fun perk or a tax write-off anymore.
Oh, wow.
It is the new permanent office. It is the singular physical space where culture is built, strategy is aligned, and the company actually exists in the real world.
Wow. The corporate offsite as the new headquarters. That completely reframes the entire industry. It explains exactly why a company would happily pay $300 a night and $20 a pastry to bring everyone together. They are using their saved commercial real estate budget to fund the ultimate gathering. Next time you are out at a massive convention in Orlando or Vegas, and you're grabbing a drink at Oli Red after a long day of keynotes, remember the digital bouncers that tried to keep this data hidden. There is a massive, highly calculated financial machine running right beneath the surface of that corporate retreat, turning your out-of-room spend into record profits. Thank you for joining us on this deep dive. Keep questioning the numbers, and we will see you next time.